My name is Argia Sbordone, and I'm a vice president in the macro group, which is part of the larger research group. I talked about the implementation and the transmission of monetary policy. The way in which monetary policy is implemented has changed quite a bit since the financial crisis, and the Fed has introduced a new operating target and new tools to deal with the operating target. During the traditional operating of monetary policy, so before we got into the crisis, there was a long period that we call the Great Moderation, in which the policy was implemented very well through manipulating the short-term interest rate, actually one particular interest rate. But then this particular interest rate that we call the federal funds rate was lowered progressively more and more during the onset of the crisis since 2007 to December 2008. And once this federal funds rate was brought to near zero, we know it couldn't go negative. And so if you needed to do more, there was the question of how you do more. And so the Fed needed to be creative in thinking about other ways of stimulating the economy when the traditional tools was impaired. When you read on the paper, the Fed has raised interest rate, or more recently, the Fed has lowered interest rate. You should think about what happened, and you should think about what this decision mean for the economy, why they are made, and what the implications they are. Students, especially seniors, are very sensitive to the condition of the economy. They are looking for a job at the very beginning of their senior year, and they look forward. And so they are sensitive to the operating of monetary policy. They're sensitive to financial thinking. We should actually have even more financial education for the students. That's part of our mission too.